Welcome to our first take of the markets. As per usual, I'm joined by ETM Analytics Director George Glynos. George, I've got a spring in my steps. The box bludgeoned the All Blacks, so I have to say my coffee is tasting a lot sweeter this Monday morning. And as we head into this week, we know it's a big central bank week, and we'll start with the Fed, who's got their decision coming up on Wednesday. Of course, we saw the massive labor data revision happening 2 weeks ago, and it's really all but the last confirmation that the COVID stimulus party that we saw has really come to an end. Excess savings have been drained out of the market. The recession flags are going up all over the place. So we're kind of expecting that the 25 basis point rate cut coming is all but pinned in, right?
Yeah, I mean, it's not just about the excess savings that have effectively reduced to almost nothing. It's also about a whole range of indicators that are alluding to a downturn. So if you have a look at the US leading indicators versus the coincident indicator, it's pointing down quite sharply. If you have a look at the size of the negative revisions to the labor data, historically, such massive revisions have tended to coincide with recessionary conditions. If you have a look at the shape of the yield curve, it's steepening back out again, mostly because the central banks are now starting to cut rates, and you know that central banks only really cut rates when, especially in an environment of inflation, when they are exceedingly worried about economic growth. And then when you have a look at the stock market indicators and you see how incredibly expensive they are, that makes it makes for some vulnerabilities, if you like, in the market, where if the earnings results don't match expectations, you could very well get a correction. And there's some indicators there that are alluding to just that. So if you have a look at some of the negative indicators suggesting recessionary type conditions, they are indicating that the stock market needs to catch up to reality. The big unknown, Ilze-Marie, and this is an important one because I actually had a discussion about this just on Friday with a fund manager, is the role that AI is going to play. And so we need to be careful how we read these labor market indicators. Labor market indicators deteriorating like this historically have always been a sign that the corporates are battling. The interesting thing this time is that the earnings results have actually held up quite well. They're still producing some pretty decent results. They haven't collapsed. Now you got to like start questioning, well, how is this possible? And one of the ways that it's possible is that the deployment of AI throughout a business, automation, AI, streamlining processes, may have extracted quite a lot of productivity out of existing resources. And so the impact of the reduction of the labor force has brought through improvements in productivity very quickly and very early on in the process, which mitigates some of that major downturn. So if you're increasing profitability, for example, as a result of the deployment of AI, and you become more efficient and more productive, then you might not experience that downturn in a way that we have historically, because and I think the difficulty for all of us right now is learning how to calibrate the impact of AI into our expectations, forecasting models, the prices of assets, and etc. So there's some really interesting dynamics, and this particular business cycle downturn, I think is going to be one for the textbooks, because it's going to teach us how a rapidly enhanced technology and improvements in efficiencies can impact the business cycle very, very deeply.
Yeah, and unfortunately, the only way we're going to know that is in hindsight. We know AI is moving very fast, but it kind of broke the models and how we look at production and factors that influence that and how it's going to play out in the economy. And it's just going to get worse. I think that's the big question. Everyone wants to know, A, how big is the impact going to be in a monetary value? I've seen several reports trying to attach monetary value to that. And how quickly is this going to happen? The pace at which is happening, it's unprecedented. When we look at past, technological revolutions, going back decades, you know, there was a kind of a rhythm to it and a kind of a pace that you can anticipate. But with AI, that is completely off the charts. It's moving at at a pace that I don't think we comprehend yet, and with that comes dangers. There comes risk with that, and I think it's going to be interesting in how financial markets is going to mitigate and incorporate that, and how we remain at the forefront, so we don't have to read in hindsight and go, "Oh, we should have. Oh, that was that." So it's going to be an interesting development. I think playing out over the next 5, 10 years. It's going to, like you said, rewrite the textbooks there for us. But moving to the next central big decision of the week is obviously the SARB that's happening the following day. So our economy is already weak. Our labor data is in the doldrums completely. At least the rand is holding up somewhat. So, this makes for an interesting decision for Lesotho Kganyago and his team. Which way should they go, George? And which way do you think they're going to go?
Again, you've just left the AI discussion. I've got to bring it back in again because I think it's a question that's affecting a lot of the central bank decision making, because a lot of people are questioning what the timeline of the impact on inflation is going to be. So I've seen at least one report from a well-respected academic institution that said that the initial impact of AI might actually be inflationary, because of the amount of investment into AI, the requirements on things like energy, for example, or requirements on chips and other IT-related infrastructure, which might boost the prices of those, offsetting some of the impact of the productivity. On the flip side, though, that's seen as a temporary hit. And we may not see that come through to the full extent of this particular report. The medium to longer term prospects for inflation are for it to come down, and the reasons for that are very clear. It's about the amount of efficiencies that are extracted due to the deployment of AI, the doing the mundane tasks or the repetitive tasks or the digitally possible tasks that much quicker and that much cheaper. So, at this point, the central banks are toiling with this notion as well. So we've got inflation that's elevated. In the case of the Reserve Banks, the inflation is ticking mildly higher. In the case of the Fed, they're nowhere near their 2% target. And yet they're talking about reducing interest rates. And I think they're taking the medium to longer term view. And they're saying, well, let's rather focus on the potential threats to the economy, and let's just trust in the fact that technology historically has tended to lower price pressures, and we think that the same might apply this time around. Also, you can take that a little bit further, because if you have a look at the Chinese data and you have a look at the Chinese money supply versus inflation data, you'll see that inflation in China is non-existent at the moment. In fact, they're worried about deflation becoming more entrenched. And so they are trying to stimulate as much as possible. But just remember, China exports a lot of that to the rest of the world. They're still the world's major export and production hub. So as a result of that starts to permeate the rest of the globe. So there are many disinflationary pressures that are around. I think the Fed is going to reduce rates. Obviously, now we're anticipating that now, and probably again before the end of the year. Who knows? Maybe even 3 times at the next 3 consecutive meetings. The Reserve Bank's in a slightly different position because they've adopted their lower inflation target. So that makes things a little tricky for them, in the sense that if they want to gain that credibility, they've got to try and bring that inflation down on a sustained basis. And they're fighting Eskom, they're fighting administered price increases, municipalities that are inefficient and require bailing out, infrastructure that's creaking. All of these things bring in inefficiencies, and inefficiencies equal inflation. So the Reserve Bank has a tougher call to make. I think they probably remain unchanged for now, and wait for the dust to settle and see how this AI impact plays out, see how the offshore central banks are playing this. But I think over time, The global rates moderation theme is very much in place, and South Africa might align itself with that theme over time, but at least for now, it's probably prudent to be conservative.
Mm. And we know Netanyahu and his team, they tend to be a bit more conservative in their decisions. So I think, yeah, they'll hold off and see exactly how a few things are going to play out. You mentioned China. Um, and I think with all this tariff discussions and central banks and the gold and the equity markets, we kind of, well, me at least, kind of took off my eye from what's been happening in China. It was a big topic of discussion end of last year, as well as the beginning of the year, as you mentioned, the deflation situation. And this is even, as they have employed a massive stimulus package. I can't remember the figure, but it was in the trillions. It was a massive stimulus package. Yet we're not seeing that filtering through in the latest Chinese data. So that's another concerning point for South Africa, specifically as its biggest trading partner, to keep an eye on. Because between that, what's happening in the US with the tariffs and us trying to figure out how to get below 30% tariff negotiations, and what's been happening in the EU, South Africa has got a lot of pressures on it, and it's coming and it's going to continue likely. So we'll keep a fresh eye on China. On the political front, though, for South Africa, we know the Mankwanazi session or the hearings are starting this week. I think he's first to appear, obviously, with the whole corruption in the police and involved with Kat Mklala, who's in prison at the moment. So we're going to expect kind of a rehash of what he said in that press briefing. The one I'm keeping an eye on, though, is happening in Doha and Qatar, which is the Arab Islamic Summit. This follows after Israel's attack on Qatar last week. And it's difficult for that region because that region is kind of, they like to have a white picket fence. They want to be seen as the stable. I'm talking about the Gulf states, wants to be seen as the stable forces in a region that's kind of, constant turmoil. So they don't like what's going on. We must remember, Iran also attacked Qatar earlier this year. They host the US is one of the biggest US military bases. Iran attacked them. Now you had an Israel attack. They don't like being in this political crossfires. So it's going to be interesting to see what the Gulf states and those attending the summit is going to come out. We are expecting, obviously, that they will take measures against Israel as a warning signal to Netanyahu to back off and not, invade their sovereignty. So I'm keeping an eye on that because it's going to place the US in a very interesting position because we know that Donald Trump wants to be best of Mikey's with all the Gulf states, but he is also, I just said Gulf states, obviously Gulf states as well as Gulf states. And he's got Israel, he's also got Israel's back. So it's going to be interesting to see where that places them. But George, it's going to be another big week as the central bank's decisions play out, and I'm sure we'll catch up again on all of that next week. Thank you very much.